Let's talk a little bit about your models. So you mentioned you guys have, these kind of models that you're using for maybe looking at things like, EBITDA, different things like that. What do your guys' models look like when it comes to uh, the investment side of this?
Well, I'm not completely sure how to answer that one for like what you're looking for. Um, I can tell you the things like we want to. It needs to pencil for us with the models at like low growth scenarios and where we come out at over 30% IRR, basically. Um, and there's IRR gets kind of met like the more you extend out the timeline, like it changes that type of thing, and so that's kind of a rough gauge that we use, and it's also not maybe we see a company that we think is completely bulletproof and it's a little bit lower than that, and we'll kind of think differently, but for most of these, we don't get out of bed if we're not making over 30% a year.
Yeah.
But also like on average, there's a lot of studies like Stanford does a search fund study.
Mhm.
There's a couple others. Roughly 10% of these are failing. It looks like that's the ones with the SBA loans. The Stanford one shows a little bit different data, but it's used differently, so it's hard to say.
Yeah.
You kind of model that too. So if we're looking at 35% IRR, we got a couple failures in there. We do 10 of these. We're still in the high 20s, low 30s type of thing at the end of the day.
Yeah.
Hmm.
Makes sense.
Yeah,
So I guess,
but you're not gonna get 1,000x return like you do with venture.
yeah,
You get some 10x's from time to time, but like
sure.
it's different from the venture model.